even right now to the rest of this year, if someone put in $100,000 and they were getting an $80,000 intangible drilling cost deduction, you're going to take that 100,000 and reduce it by $80,000. Now you have an adjusted basis of 20. But again, you're reducing income by that $80,000 deduction.
Just to diagram this out to separate the two buckets, you've got ordinary income on the left side. A lot of you guys have that coming from your W-2 or 1099 income, either from your job or your business. And then that's separate from passive income on the right side here. And of course, there's some oversimplifying this, but I think this will be useful in today's in-depth discussion on possibly using oil and gas investments to offset your ordinary income here on the left side. I see a lot of people make the mistake. They think that they can invest in real estate, get depreciation, which we're going to call passive losses, to offset other passive income. That's somewhat true. Of course, not giving any tax or legal advice today. We've got referrals if you guys need those. But generally speaking, you can use losses from the depreciation of real estate to offset your other passive income. Now, where the limitation of those passive losses comes when people try to offset their ordinary income. So a use case would be high paid couple, they make $500,000. What ideally they're trying to do here is $500,000 AGI is in this 32% tax bracket. And ideally drop it off by $100,000 or $200,000 can greatly decrease your taxes, especially because you're in these higher tax brackets here, as I'm highlighting. Now, where the limitation of the passive losses come in is if all this AGI right here, the $500,000 in this example, was ordinary, you can't really use the passive losses to offset the ordinary income. So that's where there is a limitation, and I just wanted to point that out. Now, this is going to parlay into the discussion that we're going to be having today. There is a way to offset the ordinary income with or without real estate professional status. Now, some of you guys are using real estate professional status. There's some caveats you need to do to apply and qualify for that, but very few of you guys actually do that. I would probably say under a fourth of you folks in our group are doing real estate professional status. But a lot of folks are saying, hey, I just can't qualify for real estate professional status because me and my spouse both work a full-time job. And we don't want to really mess around with like little dinky short-term rentals. You might be doing the short-term rental loophole, but in my humble opinion, I feel like that's just a lot of effort and legal liability you're just piling on yourself. And you got to do the dang thing over and over again. It becomes a treadmill. Whereas today's strategy we're talking about today, using oil and gas investments to offset ordinary income, is what we're going to be getting into. Some syndicators and sponsors out there say 100% bonus depreciation in year one. So don't get misled by that marketing tagline there. It sounds like it wipes out the taxes, but it's only half true. Bonus depreciation happens at the property or the project level, not your individual investor level. It might be 100% bonus depreciation, but there may be only enough bonus depreciation in there for you as an investor to get $35,000 out of a $100,000 investment back, right? Even though they're doing 100% bonus depreciation. So there's a disconnect there. It's always probably best practice for investors to ask individually on a investor call, how does this look? What's the guess? It's all estimates, but every deal is a little bit different. You get passive losses, have usage limits, and cannot offset W-2 or business income, which is why we're going to be talking about oil and gas investments today. Other things that passive losses can do is offset passive income. Like we said, you're staying on that one side of the bucket. And again, passive losses cannot offset your wages, W-2, 1099, or business income. And then you could possibly use real estate professional status, as I mentioned. Of course, you really need to rope in your CPA for this. But one of the biggest things is people need to materially participate in their investments. And then there's a real estate professional status that requires 750 hours and more than half of the service time in real estate. You still need to materially participate, which a lot of LPs don't. And by the way, being an LP in a syndication absolutely does not count. The real takeaway here, syndications produce valuable passive losses, which some of you guys who are doing rep status or having other rental property portfolio or syndication passive income on your K1 can use those passive losses, but there's a limitation to that on your ordinary income side, which you're going to be addressing today. I would probably urge everybody to get a hold of their 8582 form to see exactly how much suspended passive losses they have. It's not like you invest in a real estate deal, you get suspended passive losses. It's not like it just goes away. It stays suspended on your 8582 form. I'm going to be doing a future webinar on using AI to ask certain things like, hey, how much suspended passive losses do I have? And you upload your 8582 form or your entire tax return to AI. Real estate and grouping together, we jump on an onboarding call to look at your own individual situation. But today, if you have high ordinary income, today's discussion is absolutely going to be for you. Jack, why don't you quickly introduce yourself for the folks?
My name is Jack Hollander, speaking to you from Long Island, New York. I'm a tax lawyer by background. I have been in the capital markets for the majority of my career, working with different companies that provide alternative tax mitigation strategies, be it oil and gas. I like participating in presentations like this from an educational standpoint, because I think it's really important for people to really have a good understanding of what they're getting into, how things investment wise can benefit themselves.
Yeah, before we go any further, none of this is to sell any securities. And of course, consult your own CPA, tax attorney, etc. We're not giving any personal financial investment advice.
I appreciate what you were getting to, Lane, in the discussion just now, because people need to, on a year-round basis, really talk to their professional advisors, CPA, financial people about their tax situation and to really understand the terminology that you were alluding to. So even though we're year end and people might be scrambling for tax savings, given that we have a few weeks left in the year, come January 1st, people should not hesitate to talk to their professional advisors about tax planning for the coming year. I want to compliment what you were saying about terminology, because I think it's really important for people to understand. Because when people ask me about, hey, I need to shelter some income for this year, there's a number of questions that need to be asked so that we can properly mirror and match a investment vehicle with income that somebody has. And from an investment vehicle standpoint, are we talking about an individual making the investment themselves? Is it into a partnership, limited liability company, trust, qualified account? So all these different vehicles, if you will, can make investments. But again, we have to see what the right opportunities are. And as you were alluding to, Lane, understanding income and deductions. And I always point out here with this slide that really the way that tax law works, everything goes into buckets. So when you have ordinary income, it's offset by ordinary deductions. When people have capital gains, and typically a long-term capital gain is when certain assets are held for more than 1 year, capital gains are offset by capital losses. Passive income, as you were alluding to, is offset by passive losses. Portfolio income is not passive. Portfolio income is really defined as dividends, interest, pension distributions, required minimum distributions. To me, that is really portfolio income to be distinguished from passive income. Above the line versus below the line. Typically, income deductions gets us to adjusted gross income, and that's where we're dealing above the line. Below the line occurs after one is able to ascertain adjusted gross income, itemized deductions, standard deduction, if you will, those take place below the line. And again, an itemized deduction versus standard. Standard is a fixed number. Itemized deductions, if you have significant deductions, you itemize them because typically that would be significantly more than a standard deduction, and that's why you would take the itemized deductions on the return. Deductions offset income items and tax credits reduce taxes that are owed. And I always get a little bit frustrated with people when we have a conversation, especially around oil and gas, when they're like, hey, tell me about that tax credit. We're not talking about a credit, which is a dollar for dollar reduction of the actual tax liability. A deduction reduces income to get to eventually taxable income.
People loosely say, I bought that piece of software for my company and I just deducted it. If that software cost $100, it's not like they got $100 credit in their taxes. Really, they got to deduct their income for their company by $100, which for most people, that could mean 10 cents in the dollar to maybe 40 cents on the dollar.
In tax savings, correct. Basis is a tax measuring point. When you buy something, the cost of it is your initial basis. When you have investments, especially partnerships, you start with, let's say, $100. If you get a loss, you reduce the basis by $100. When you have income, you increase the basis again by that amount of income. And if you have cash distributions, you reduce the basis by that distribution. And that's what we call adjusted basis. So at the end of the day, when something might be sold, when you've owned it for a period of time and you're getting what they call an amount realized, meaning this is the sale price that you're selling something for, you subtract that adjusted basis to determine the gain. And once that gain is determined, then we have to characterize it. Is it ordinary? Is it passive? Is it capital? Things of that nature come into play. Not all income is taxed at the same rate. We go through marginal rates. So when you look at the brackets, income for certain levels to a certain point is taxed at a certain tax rate, lower rate. Then the next level, grouping, is taxed at a higher rate, and it gets to the top rate of 37%. So again, a lot of times when people do some sort of projection, they just may take the top bracket amount. It's scaled somewhat, so it's not going to be an exact science. But just keep in mind that not all income is taxed at the same rate, especially the difference between ordinary income and capital gain.
Before we move on, if anybody has any questions, feel free to put it into the Q&A. We want to try and keep this interactive, and we don't want to lose anybody behind as we start to build on top of this. In the future, if this is something you're interested, we can definitely jump on a call and we can walk you through this.
That goes to the whole concept. You should do it year round and not expect to just the last part of the year absorb all these concepts, because you want time to digest it, ask questions, and learn about these things. So now we get into what I consider financial planning investment considerations. And in general, when you think of a portfolio, you're looking for assets that could appreciate, okay? Appreciate potential. Think of stocks and bonds and mutual funds and things of that nature. You want to have a portfolio that's diversified. We always hear about that. Market goes up, it may go down. You want to minimize the losses by having a diversified portfolio. Are the distributions going to be fixed, or will they be variable? Will they be paid weekly, monthly, semi-annually, whatever it may be? Again, when you make an investment, you want to have an understanding of how distributions are going to come out. Secondary market considerations is important. Liquidity options. Can you just call up your advisor and sell something right away? Or is there a limitation, or you don't have the ability to liquidate the investment? And then, of course, risk versus reward and current and future tax benefits. So the point of this side is to say, hey, you want to have all different kinds of investments, but at the end of the day, you also want to have investments as part of a portfolio that provides you with current and future tax benefits. So now, how does oil and gas investment fit into this? When it comes to appreciation, an oil and gas investment is typically a depleting asset. A well has so much oil and or natural gas in it when it starts. I always tell people to think of it as inventory in a warehouse, and every day we're selling off that inventory until theoretically there's nothing left. So it's a depleting asset. It does provide portfolio diversification. And typically when you go into an oil and gas program, depending on the program, but you're never really investing in one, you're going to invest in multiple wells that would be within the partnership program that you invest in. Typically with oil and gas, you have variable distributions that could be paid monthly or quarterly. The reason that they're variable is that you're going to have different production amounts each month, each pay period, and also pricing changes. We know that commodity prices changes very often. In terms of secondary market considerations, when you're dealing with limited partnerships, it is deemed to be an illiquid investment, meaning there is no readily available secondary market. So you got to expect to hold on to this on a long-term basis. Risk versus reward, oil and gas. To me, in today's world, finding oil and natural gas is not such a big risk. The programs that you would look to do is what we call developmental drilling. You're drilling in areas that have already found oil and natural gas. You're not wildcatting. You're not doing exploratory. It's really a manufacturing business. So the biggest risk is commodity pricing. And right now, oil is trading at about $59 a barrel, and natural gas is getting up to about $4.50 per MCF, which is 1,000 cubic feet. The current and future tax benefits in oil and gas, and that's what we're going to get into now, is what's called intangible drilling costs, which creates a large deduction the year of the investment, followed by depreciation and a depletion allowance. So there are different ways that one can invest in oil and gas, and stocks, mutual funds, ETFs, master limited partnerships, MLPs, which is really nothing more than a publicly traded partnership. Then you have royalties, working interest, and direct investments. So typically when someone is looking to have year-end tax planning with an oil and gas investment to shelter income, they're looking at a direct investment through a limited partnership. In today's world, and again, I've been doing this for a long time, so I've seen a progression here of some changes over time. And again, we're talking about the commodity of oil and or natural gas, because when you're in Texas, the production is going to be predominantly oil, though there can be a fair amount, large amount of natural gas as well. And if you're in Appalachia, Pennsylvania, let's say, the Marcellus Shale, you're talking predominantly natural gas. So if I'm talking to somebody and they want to have a oil and gas investment to shelter income, are you more interested in oil? Are you more interested in natural gas? Do you want a combination of both? Because right now, what's going on with data centers and AI, okay, everybody knows that you need a lot of electricity for that, and natural gas is the component that manufactures, if you will, electricity. And that's why a lot of people are very bullish on natural gas, though we'll always be bullish to a large extent on oil as well. And then you have this concept of an operator versus a non-operator from an investment standpoint. A company that does their own drilling, vertically integrated, they prep the well, they drill the hole in the ground, though they will still hire subcontractors, and then they'll operate the well once the well is drilled. Those are the operators. But there are programs today where you get similar tax benefits where you're investing with majors, Exxon, Shell, EQT, Marathon. They look for third-party capital to drill their wells because you're dealing with very large horizontal wells that can go 10,000, 12,000 feet vertically and 10,000 feet horizontally. And those wells cost multiples of millions of dollars. And therefore, they don't want to keep spending their own money. So they take in investor money to participate in the drilling of those wells. Once those wells are drilled, those major companies are the operator. So in oil and gas, direct investment reduces. This is what is pretty exciting about oil and gas investing. It makes it very unique. As Lane was saying, you could have ordinary or active income, so it can reduce active income, W-2s, bonuses, things of that nature. It can reduce portfolio income. It can reduce capital gains, though the way the tax return works, you're first going to shelter or offset ordinary income items before you're going to offset capital gains. Passive income, meaning income from other partnership activities like real estate. Maybe someone's got stock options. Alternative minimum tax, though far fewer people are in the AMT these days, but there is a potential benefit from an oil and gas investment in helping reduce to some extent the alternative minimum tax. Self-employment tax, another area that can be benefited from an oil and gas investment. Closely held C corporations, the business income within that entity can be sheltered by oil and gas. 1031 exchange boot income, pension income, required minimum, it's the gamut. We say that an oil and gas investment can offset any source of income. And this just proves that.
Yeah, so some of you guys are selling off your rental properties, trying to trade up and don't want to go through the cumbersome 1031 exchange. Those people doing the lazy 1031, we have a e-course for maybe 8 or 9 different methods. Oil and gas is one of them, and it's a catch-all, as Jack says. I think also the use case where guys selling your crypto, right? Got some nice gains in that, but that falls under the ordinary income portion. So that's where oil and gas is a bit of an enigma in a way. People ask, how can I offset it? Maybe Jack can talk about how the government, I mean, it's incentives, right? It's written into the tax code specifically for this, but maybe talk a little bit like why do they do that?
It's been in the tax code forever. And it's interesting how every time there's a new administration, they always talk about maybe eliminating the tax benefit. But really, the oil and gas industry in this country was really built by mom and pops. And you really can't get rid of the industry. When you think about it, if the population in this country is like 430 million people, and it's going to grow to, let's say, 500 million people over the next 30, 40 years, what are the things that you always need? You're going to need real estate. You're going to need clothing. You're going to need housing. You need water, and you're going to need energy. And solar and wind and some of these other things you hear about cannot accommodate the population when it comes to the need for energy. And that's why oil and gas will always be around. But the way it always started out, because it's risky, you're drilling a hole in the ground to find something, given the opportunity to have some tax benefits that you can write off. It's like R&D, research and development costs that you can offset right up front.
And certainly the United States wants to get off foreign reliance of oil in the Middle East, Russia, China. So, they've
Absolutely.
thrown these incentives in there too.
Going back to the point that if I look at either individuals or financial professionals with clients, I always say it's not for everybody in a book of business, but every professional has a client or two that has a need for tax reduction strategy like oil and gas. And the reason we say that is someone's going to have a lot of wages, W-2 income. Maybe they have a lot of self-employment income. Maybe they're getting a really big bonus this year. Maybe they exercise stock options, sold a business, creating a lot of capital gain and recapture. Traditional IRA conversion to a Roth IRA, where you're generating income from that. That income from the conversion can be sheltered by an oil and gas investment. As we said, required minimum distributions and other pension distributions. Recapture due to liquidity events or roll-ups. Closely held C Corps is where 5 or fewer own more than 50% of the stock of the company. It's not a pass-through entity. It's an actual tax-paying entity, can come into an oil and gas program, actually as a limited partner, not a general, and offset the active income of that business. One question that is frequently asked is, what about limited liability company and S Corps? They should not make the investment themselves because where they have limited liability, corporate veil protection, okay, you can't be a pure general partner. We're going to address that right now so that it doesn't make sense. They can come in and be a limited partner and have a passive loss, but they can't have an active deduction from the LLC or the S Corp. So again, because people ask all the time, can I come in to these programs, use my LLC? And the answer is you cannot.
Yeah, I'm looking down the list of attendees here. A lot of pilots, some single folks. So, if you can't do rep status and you make over $200,000 a year, I think this is definitely something that maybe we should jump on a quick call and discuss.
Okay, so now here's where we start getting a little bit more granular about how well this actually works. So I said earlier, there are 3 different tax benefits associated with oil and gas. The first one, the major one, is called intangible drilling costs. Clearing an area to drill a well, take the trees down, build a road. They make a pad, consider a pad like a table, okay? That's where they're going to poke the hole in the ground. The cost to poke that hole in the ground, the expense to do that, to drill that hole, those are intangible costs. They're real expenses, and there's no equipment or anything like that could be depreciated. That's why they're called intangible drilling costs. They make up the majority, could be 70, 80, 90% of a well cost is going to be allocated, if you will, to these intangible drilling costs. When you go into a different program, it's usually about 70 to 90% of the investment amount is going to be allocated towards these intangible drilling costs. So if somebody put in, even right now to the rest of this year, if someone put in $100,000 and they were getting an $80,000 intangible drilling cost deduction, okay, you're going to take that 100,000 and reduce it by $80,000. Now you have an adjusted basis of 20. But again, you're reducing income by that $80,000 deduction, okay? Now there is a choice, and most people don't take advantage of this choice because they'll take a deduction for what they need for the year. But the choice is to fence, take whatever you can use this year, or amortize it over a 5-year period of time. Okay. Now, how do these companies do this? How are they able to create such a large deduction year end? The tax code has two requirements. One, all of these intangible costs have to be paid by year end, paid to the operator by year end. Okay. Prepaid by year end. And then you have to start drilling the wells. We call it spud the wells by the end of March of next year. 90 days following the close of the year, you have to start poking the hole in the ground. Spin the drill bit around a few times, you're spudding the well. So as long as those requirements are met and you invest in something between now and the end of the year, you can get that 75, 80, 90% tax deduction for 2025.
And I'll walk a little bit further with this. And of course, you need to consult with your own CPA with that. But you invest 100, you get 70 of deductions. Now you go to your AGI, and that's what you use to lower your AGI on your personal side.
Correct.
I got a question. I don't know if this is super important, but these are intangible drilling costs we'll refer to as IDCs. But the tangible drilling costs, that's all like the piping, that's all these physical things that I'm guessing because you can deduct those materials, etc., the government doesn't want you to double dip. Is that kind of why? So we're getting those deductions elsewhere.
It's a different asset. Like I said, the intangible are actual drilling costs. And then for depreciation, it's equipment. There is equipment that is associated with the well, compressors, pipes, things of that nature that are owned by the partnership. And therefore, that's what's subject to 7-year depreciation. Under the tax law today, you could take 100% bonus depreciation. As long as that asset, that equipment is placed in service, you can take 100% bonus depreciation for it. And by the way, it's not really bonus. It's not additional depreciation. It's an acceleration of depreciation you are otherwise allowed to take. Okay, so having a greater deduction up front is great because it's all about time value of money. You want to save tax dollars, and therefore, if you can create more deductions early on, that's an advantage by lowering income, puts more money in somebody's pocket. And that depreciation is used to offset future income. Because remember, what we're doing is we're creating a new business, drilling wells, finding inventory in that warehouse, and then we're going to sell that inventory, sell that oil and gas. Okay. That's going to create revenue or income, but we can partially shelter that with the depreciation deduction that may take place next year. And then to the last column, there's a 15% depletion allowance. It's 15% against the gross income derived from the wells as long as they continue to produce. You got $100 of income, $15 is not subject to tax. You pay tax on $85. So again, you have depreciation, partially shelter income, but then you have that 15% depletion allowance through the life of the program as long as the wells continue to produce.
A lot of our folks are very familiar with the depreciation in real estate syndications. So I think that center category is very familiar to them. In real estate deals, when you sell the asset or you exit the deal, you have to recapture all that. Is that still the same case here?
Yeah, it is. Intangible drilling cost is subject to recapture. Depletion is actually to be subject to recapture as well. But let's go back to the initial adjusted basis. You start out with $100. If now between the deduction of $80, you're down to 20, you have income, you got cash distributions, maybe that adjusted basis is $10, 5, 6, 7 years out. Okay. You're selling that inventory. So the value of what gets sold cannot be the same as day one. Because every day we're selling off that inventory, nobody can say, hey, Lane, give me all my money back because you get your money back piecemeal. So now maybe if there was a sale and that adjusted basis is 10, maybe you're only getting $30. So the gain is only $20. And that's what would be subject to the recapture.
I think I made the mistake on this like maybe 5, 10 years ago. Unlike a real estate deal where the basis actually increases greatly. In this case, I think somebody taking a quick look at this, the value of it depreciates, goes to nothing. But in this case, for tax reasons, that's exactly what you want it to do.
Right. You'll have much less gain. Not great, but you're getting your money back from the tax benefit and from the distributions, the sale of the oil and the gas. And by the way, you mentioned earlier with real estate, in some cases, if you're not the professional, you need the material participation. In oil and gas, you do not need to have material participation to get the write-off. So here again is what makes oil and gas really unique. We talk about ordinary deductions and passive losses. When somebody goes into an oil and gas program as a general partner, and how do you go in as a GP? There's a subscription agreement. You check the box that say you want to be a general partner. When you're a general partner, and everything we talk about with the code, what is the definition of an intangible cost? You got to prepay IDCs by year end. You got to spud within 90 days. If you're a general partner, all these things are part of the Internal Revenue Code. It's not gray, it's very black and white. Okay. When you come in as a general partner and you get that 80, 90% deduction derived from the pass through of these intangible costs, it is an active deduction. It is not passive. The concept is when you're a general partner, you are deemed at risk. That's what a general partner is. If there are expenses that can't be paid otherwise, a general partner could be called upon to pay it. Okay. So if you come into a program as a general partner, you will get a large upfront deduction to offset any source of income that you have. Now, I will tell you, having done this for 35 years and raised billions of dollars in oil and gas, I've never, ever seen, heard, experienced anybody investing as a general partner have any sort of liability because they were a general partner to start. So we'll never say never, but in my opinion, and you can take it for what it is, nobody should lose sleep at night. This is the way this whole industry performs. There's a lot of insurance. The partnerships have to have substantial insurance. Subcontractors are insured. You have partnership assets. There's a lot of protection before anything would remotely get close to an investor general partner. Again, it shouldn't stop someone from coming into a program if they're motivated to have some sort of tax planning. And
Yeah,
what
and
typically
additionally, a lot
happens,
of these projects, at least the ones I look at, you look to get out of that spotlight after the first year. Because after the first year, you've got the vast majority of the ordinary losses or active losses, as you said, and that's what you flip-flop to
that
passive LP.
that's what I was just going to say, that the following year, once you got the write-off, everybody gets automatically converted to a limited partner status. It's a non-taxable event. Now you're getting income. You're going to report the income no matter what. You don't have to be a general partner. Okay, so that's just the benefit of it. And by the way, as this slide indicates, the third bullet on the left, income in subsequent years is active, not passive, even though someone's converted to a limited partner status. Again, there's a code section for that. A lot of people don't realize that. They get a K1, they see their passive, it's income. It's going to be treated as passive income by the tax preparer, but technically it's supposed to be active income. Just point of information. And I want to skip to the third column there with self-employment, because when somebody is a general partner, they are deemed engaged in the trade or business of the partnership. They're not a limited partner, they're general, they're deemed active. That's where the deduction, this IDC deduction, will offset self-employment income. When they're converted to a limited partner status, income will not hurt them for self-employment purposes. Again, this is what makes oil and gas so unique, that there are so many great positive tax implications. Reduce self-employment income by being a general partner, and you're not hurt later on when you get the income as a limited partner. Now, let me go to the middle column, passive loss deduction. If you don't want to be a general partner, you don't have to be. If you have, as Lane was saying, if you have a lot of real estate passive income, then you can go into the program as a limited partner. All you do is check the subscription agreement that you want to be a limited partner. You get the same percentage write-off from the intangible drilling cost, and now it's characterized as a passive loss. So again, lots of ways to figure out how to use this type of write-off. Again, you want active, you want passive, closely held C Corp, you want to shelter self-employment income. All these kind of considerations can come into play. And it's just for me, because I'm a tax guy and I've been doing this a long time, I just want to ask certain questions to make sure it's positioned the right way if someone's interested in doing it. Maybe only one spouse is self-employed, okay? How do you split that up then between two people, right? So therefore, if one spouse is self-employed, that one spouse should be the one making the investment. So they're not getting this return. They'll file a joint tax return, but they're not joint ownership of the partnership investment itself. Only one spouse should invest in the oil and gas. They'll benefit from the self-employment that way. And again, you get the same benefits, depletion, even when you're as a passive loss or passive investor, you'll get depreciation and you'll get the 15% depletion allowance as well going forward.
That all sounds confusing, but from a tax perspective or a form perspective, you're just getting a K1, right? I think that's what I remember, like when I did my first one in 2018 or 19, it was a K1 for both the first year and then subsequent years, I recall.
Correct. But I always say, if you're going to have people invest, it's always good to give them a little heads up as to what to look for when they invest and they're talking to their tax preparer to make sure the return is done correctly. You want to make sure they're a general partner and it's treated as an active deduction. If they're self-employed, you want to make sure it's treated the right way on the return. Those kind of considerations.
We had a question come up. When you say self-employment, are you talking about 1099 income?
No, we're talking about Schedule C on the return. Self-employed, you have your own self-employed business.
Yeah.
Okay, thanks. And again, at the end of the day, we want to make sure you manage expectations just like with any other investment. So one of the things that people very often will ask me, what can I expect each year in terms of a distribution? And I tell everybody, listen, it's variable. So I can't tell you what it's going to be every year. So the better question to ask is how quickly can I get my money back? It's illiquid, right? There's no readily available secondary market. So how am I getting my money back? Cash on cash, cash and tax. And the other thing, when you talk to companies, they may say, hey, we drill a well and that it pays back in, let's say, 2.5, 3 years. And that very well may be. It's very common. That's factually accurate. However, when you're in a partnership like this and you have multiple wells, there could be 15, 20, 30 wells in a program. They are not all turned on at the exact same time. And therefore, a more realistic expectation of getting money back cash on cash is probably about 5 to 6 years. Cash and tax, Lane said earlier, you put in 100,000, you're in whatever the tax bracket, your actual tax savings is, let's say, 35, 40%. And by the way, most states do allow for the intangible drilling cost deduction. Okay, so you get the state benefit as well. And so take that 40% tax savings, cash. How long is it going to take to get all my money back? And by the way a well performs, again, think of it as a bottle of water filled to the top day one, okay? About 50, 55, 60% of that water in that bottle is going to come out of the ground in the first 3, 4 years. We call that flush production. The remaining 50, 40%, whatever that number is, can literally take decades. And that's why we say distributions will slow down. There'll be less. So your distributions will go down. But it's not uncommon to get 15, 20, 25, 30% cash on cash in the early years when you got great production together with really positive pricing. Okay. And it's also on the buy side. The well is drilled, costs aren't out of control. Companies pretty much know what the cost of a well should be. Okay. So when you factor all that in, you may be getting most of your money back in the early years. You come into this again, portfolio diversification. You come in, you want that great tax benefit. You're going to get really good early on distributions and reinvest those distributions for other suitable assets for your portfolio. Make it part of a portfolio strategy. That's the ideal way to utilize something like this. Yes, it's driven at this time of year by the tax savings, but it's about time value of money. Okay. Big tax savings, big return from the savings, really good upfront distributions because they will diminish over time. And that's when people say, I don't understand my investment. What happened? I was getting all these great distributions and now they're not as good as they used to be. One, you forgot you got the tax benefit. Two, you're beyond flush production. And so again, this comes down to manage expectations. Because if you did put in 100 and you got that 40% tax savings, you got another 70% cash on cash, let's say, in the first couple of years back, and you reinvested that money, you're going to have more than $100,000 of benefit back into your portfolio. And that's the ideal way to utilize this.
The big picture here, guys. So you're getting the tax savings right up front in the first year. And for most of you higher income earners, you're trying to at least duck out of that first tax, the highest tax bracket you're in. Whether you want to drive your income down to way less, that's up to you. There's a little bit of diminishing returns, I think, as you start to get really low adjusted gross income. That's the biggest thing there. And then hopefully you can recoup your original investment in from that flush production, and then the rest is all gravy. But the big picture here is you got your money back, and it's a concept of velocity of money. We're getting the money back out, and then maybe you invest in something like this again. Maybe we'll see you again in 2028, I guess. Or maybe you put it in a real estate deal, or maybe you use the money for something else. It's the concept of internal return on investment, IRR, which normally I'm not a huge fan of. But in this case, it's all about IR, turning your money, velocity of money. Make sure you understand that. Like, it's a pet peeve of me because we've been looking at a lot of these different operator and non-operator funds out there. And some of these guys will do really wonky things with their projections and include the tax savings in the projections, which I don't think is right because everybody has a different tax picture.
You're correct. Typically, from a track record standpoint, somebody would show cash on cash, and then they would show cash and tax savings. So the tax savings, they would usually presume someone's in the highest bracket.
I got a question. Our group some folks would do land conservation easements back in the day. Today, that's a big no-no, which is why we've moved to more of this direction. With that, I believe at one time they had some type of rules in place where you could only use the land conservation easement deduction to drop you to 70%, or you could only use up to 30% as a deduction of your total income.
Adjusted gross income.
Is there any type of restriction like this with this stuff?
To me, it's a function of comfort level, right? If I'm a financial guy, how much are you going to have a client put into something like this versus other investment opportunities? You're not really sheltering 100% of income because, again, you still have maybe an alternative minimum tax consideration, but you don't want to knock yourself all the way down. And so you want to be prudent in making an investment. It's still an investment no matter what. You want to be able to have something that's reliable. You're going to make your money and all that kind of stuff. I know with the easements, you had a 3, 4, 5-to-1 write-off subject to a percent of adjusted gross income. This is just, again, it's diversification. It's investing in energy. It's giving you a very good upfront tax benefit. You get, as we're saying, time value of money, very good distributions early on, but you got to keep in mind, until you have all your money back, it's really a return of the investment versus a return on the investment. So let's say 5 years, you have 100% cash on cash back. Okay. And again, that's what makes this also unique in a way because it is a return of your capital. You're getting your investment back. And once you have it all back, you stay in these deals. It's like mailbox money is what everybody calls it. And you're right. People come in year after year. It's like dollar cost averaging. Come in next year. The pricing might be a little different. Production could be whatever it'll be. It works. It's been known to work from the tax benefit, cash flow, but you want to make sure you're working with a good operator that has a track record, good management. And again, you're going to find production. At the end of the day, you will have production, you will have cash flow. Nobody invests in one. You're going to be sharing, have a participation in many wells within a partnership.
And something that I key in on too is there's different basins. We're not going to get into this today, but different basins around the country that are a little bit more prime than others. And in a way, just like how we rank class A, B, C markets and properties, there's A, B, C wells that are a little bit more prime. Obviously, they're a little bit more expensive to get into because they have better deposits. Can you go over the best case scenarios with say somebody did $100,000 and their AGI was about 500? What would be like the worst case scenario, and then what would be the best case?
Again, if someone's making $500,000, how much are you going to put into a program like this? Would it be cash available? Let's assume it's $100,000. Okay. You're getting an $80,000 write-off, 90,000. Let's say it's 80,000. Okay. So now you're paying tax 500 less the 8. You're paying tax on 420. Okay. So you do have that tax savings opportunity, 35,000, $40,000, something along those lines based on the investment that you're making. Best case scenario, again, is how quickly am I going to get my money back? The worst case scenario is yes, you'll get your tax benefit. Yes, you'll get distributions. The question is, will I actually get 100% cash on cash return over time? And that's why, again, I'm an advocate. Reinvest those early dollars in other suitable investment opportunities. Like anything else, there's a risk component to any investment. You're not going to take all your money and put it into a program. There are programs you can diversify and go into different programs. Some programs don't really have a liquidity feature. Other programs do, by the way. Some programs are out there that can provide some liquidity. They'll look to sell assets within 7 years. Some programs provide a mix of natural gas and oil. So you get a little bit of diversification there. So you're not 100% dependent just on oil or dependent on natural gas. But companies, you're dealing with reputable companies. They're vetted. The management's vetted. We're not talking about any new kids on the block. There are different basins in Wyoming and the Dakotas, and we all know Texas has different basins. Then you got Oklahoma, and then you have Appalachia. And over time, all the wells drilled were vertical wells, just straight down. Now, a lot of the wells, yes, there's still a lot of vertical drilling, but a lot of horizontal drilling, which provides for a lot of cost efficiencies.
Did that make
Yeah.
sense?
Yeah,
Go
I
ahead.
had a question, Jack. So one of the things that I understand is that the quality of oil is different in different places. Maybe your Saudi Arabia has really pure, really good oil, but then some of the oil they frack out in like Wyoming, that's a little messier. And so it costs more to get the oil per barrel. And so as the cost of oil goes up, there's a lot more interest to go dig wells out there and like your Wyoming. And I'm curious, I guess I'm just trying to understand how much risk you're taking if the price of oil really changes on you and really goes down. I guess that's my question.
Once a well is drilled, because the real primary cost of an investment is drilling the well, right? I'm saying a well could be 6 million, it could be $10 million per well. But once that well is operating, the cost to operate it is not that much. And you could hear all different stories about what's the break even. Like Saudi Arabia, you may hear it's $70, $80 a barrel for break even. A lot of times in Texas, you're going to hear it's probably in the $40, $45 range. But once a well is actually operating at the wellhead, it may only be like $20 as a break-even price. Companies do have the ability on an as-needed basis to shut in production if it's appropriate to do. But again, because the operating cost, once the well is producing, is significantly low, even with a lower price point, they're still making money. There's still the opportunity to make money. while I agree with you, Wyoming and all that, it's a heavier oil. The real issue from Wyoming and the Dakotas is really transportation because you're so far away from the markets. Where Texas to get to the Gulf and all that, it's much easier. But all those transportation costs are factored into the models. So we would know how well we're doing. We have a good idea what should come out of the ground because, as I said, it's all developmental drilling. We're not wildcatters. We're not doing exploratory. We know just by how many wells have been drilled in the area in the past, what the average production should be. And I say average because some wells will do much better than others and some will not do as well. And therefore, when you have multiple wells, here's the average that we can expect. And also keep in mind that many of these companies, they will hedge their pricing. They're never going to hedge 100%. You want to have some upside potential, but you also want to protect the downside. So hedging is very often part of the modeling, part of the operations plan, so that you are protecting the downside. And companies can look every day what the futures market's going to look like. And that's how they model these things out. But just like gas for the car, right? It could change every day to some extent. And while oil is more dependent, you deal with Saudis and more international issues. Natural gas is all domestic. It's weather, it's commercial use, things of that nature. It's electricity. So it's all about supply and demand. If the demand is there, we have the ability to accommodate the supply. And when you have that imbalance, if you have more supply than demand, your price is going down. If you have more demand than supply, your price is going up. But companies are pretty good at navigating the market and controlling what they can control from a cost standpoint. A couple of years ago, wasn't that long ago, oil went down to $20 a barrel, and a lot of wells got shut in at that point in time.
You were talking about there was two categories of places to invest with a direct operator or with an Exxon big company. Do you have thoughts on that? Whether maybe the direct operator might potentially make more money, but I also could see where there might be more risk.
But again, you want to have the opportunity to invest with management that have been around for a while and they have a positive track record. So I could tell you a company, MDS Energy, okay, they're in Appalachia. It's an old family run oil and gas company, very big in the Marcellus Shale. They've been there forever, probably 50 years in the Marcellus. They are an operator. Okay, they control a lot of what goes on in drilling the wells. But I know companies that move to Texas, and again, they establish relationships with some of the majors because early on, to participate with the majors, it was a bit of a bidding war. So you may be overpaying to participate with them, but the benefit of dealing with the majors, you're relying on their due diligence, their expertise, the companies they use that they want to control costs because they do have plenty of their own CapEx that are involved in drilling the wells. Because if your capital is the last piece of the capital stack, those wells are ready to come on and produce much sooner than if you're raising the money, it takes time to do it. You may be 6, 7, 9 months out before you start seeing distributions.
We had a question earlier. Investor was interested in using their Roth conversion aspect. I don't know if that kind of clashed with, like you said, can investors take ownership in this within an LLC or any type of not entity
So,
that's not them, right? Like a Roth or a self-directed IRA, for example.
so let's just LLCs, S corps should not come in if you're looking for an active deduction, because if state law limits liability, corporate veil protection, they're not a pure general partner. If the law had allowed that, I'd be setting up single member LLCs all day long to have people invest. And that's why it's not advisable to have an LLC invest if you're looking for an active deduction. When we talk about the Roth conversion, if you take an IRA, convert it to a Roth, the fair market value of that asset that's being converted, you have to pay income tax for that conversion. By investing in oil and gas, again, it's income that winds up on the face of the return. The IDC deduction winds up on the face of the return. So there's an offset there. So that's how you can shelter income from taking a traditional IRA converting it to a Roth. Now, can you take IRA money itself and invest it in the oil and gas program and then take that partnership interest and convert it to a Roth? Yes, you can. However, what is the discount that would be utilized? Because that's what you would look to have happen. So put in $100,000. Next year, you do the Roth conversion. You're not individually getting the IDC deduction because it's sitting within the IRA, if you will. So you don't have personally the benefit. When you do the conversion, okay, and you need to have some evaluation what the value is, but there are discounts, lack of management, limited partner, things of that nature. So maybe there's a 60%, 50%, 60% discount. So when the conversion of that 100,000 is done, you're only paying tax on 40,000 as an example. But they need to have set up what's called a tax blocker because you have to deal with UBTI, unrelated business taxable income. To me, it makes it a little bit more complicated unless you have a lot of money that you're looking to convert to do 100,000 or some amount. I'm saying you could do the Roth conversion and shelter the income. I'm saying to have the investment made with inside the IRA. To me, 100,000, it's not worth it. I know many people over a number of years have used oil and gas to shelter Roth conversion income.
Yeah, you guys can do this however you guys want, but to me, which you guys are mentioning earlier, doesn't make any sense. But if you were looking for a way to get your money out of those 401ks, self-directed IRAs, Roths, etc., you realize income, but this would be a hell of a way to offset that ordinary income in itself.
Yeah, I know it's a lot of information to digest. It's a planning opportunity. And again, it gives portfolio diversification, good tax benefit year end. There's nothing really like that because I'm asked a lot now, what do I do? How do I shelter my year end income? People have capital gain income. And again, you can shelter that. But again, you're first going to offset ordinary income items before you get to the capital gain items.
The first thing you look at is, are you going after owner operator versus the bigger guys? You obviously want to stay away from like these small cowboy outfits. You want to look for guys with a track record that you can verify. But the bigger guys, obviously, there's more overhead there. You didn't really mention that, but that's obvious, right? The other thing is, do you go after wells that are already producing? There's a trade-off with that. You get more cash flow there. You miss out on that initial flush. But I think the right answer where we're heading to is a bit of a blend. But the reason why you do this is mainly for the tax benefits on the front end. If you're aged around 750 and you're in this highest tax bracket, yeah, I think it would be smart to drop it down to 500 down to 400. Maybe you invest 150,000 in one of these things to capture those deductions to drop you there. And then you're asking earlier, what's the pessimistic estimate on this? If you don't hit any oil on your multiple wells, then that's your base case scenario, right? But then you look to, okay, what are the track record of these operators in the past? And generally speaking, they usually recoup their money within the first several years. And then this is when you also dig into, all right, where are you guys drilling? Is it grade A, grade B, grade C? And is it horizontal wells, vertical? What's the strategy? I think the biggest part of the due diligence that we look at is like the geologists, getting a third-party geologist on board. Because that's really the big factor is like how much oil is in that basin? Like how good are where they're drilling, where they're poking holes?
Yeah. One thing that I'd asked ChatGPT, it said that there is no way to unlock your passive losses. I have a lot of real estate passive losses, but this would not be a way to unlock them and use them. This is an active loss that's special, like the land conservation easement was. I'm just still trying to find ways to unlock. I have a lot of suspended passive losses. So that's one of the things that I'm still looking to tackle too.
That's the trouble with passive loss. It's great to offset other passive income, but it's useless to offset the ordinary income if you're not doing rep status, which is most of the people out there.
Rep status it's got to fit. It's a ton of time and energy. And for some people, it just is a great fit, depending if they have a spouse that sort of fits the right spot and you all want to do it. But no, it's also time, energy, and money that you only have so much time. I'm a little fuzzy a little bit on some of the depreciation recapture piece, but he did a good job. I'll probably have to watch it again to understand. Again, there's just different categories.
Yeah, go back and re-listen to it, but essentially the basis goes down to nothing, and that's that you recapture. So it's somewhat negated. Whereas real estate, the basis actually goes up, which
A
is
little
why you need
piece.
to hold on to your passive losses. I know you got a lot of it and you
Yeah.
can't use it today, but you're going to use it in the future.
But then also there's that piece with the machinery, right? And there's going to be some write off of equipment. That's always nice because you don't have to recapture the equipment.
Yeah, because that stuff degrades over time.
No, a lot of good things, especially let's say you were going to do a big Roth conversion or something in a year, boom, that would, and you could just time it and do the same year that you take this. It seems like a really good first year. After that, it's less good, but not bad.
Yeah, the guys who do this, they start looking about this time of year where their AGI is going to fall, where in the tax brackets are they falling, and then whatever magic number they're shooting for, whether it's 394 or 200, that's basically how much they see how they can buy into this stuff for, if they got the liquidity lying around for it. Of course, you don't want to have an overexposure on oil and gas, but I think for a lot of people, they don't have any. So they don't have to worry about that too much. But that's kind of getting a little bit more advanced at that point, more into asset allocation mix, which I'm not allowed to talk about.
Yeah, the general partner risk stuff was a little interesting. I think he's probably right. You really don't have to worry, although you're not shielded by an LLC on this. So there's potential there.
And I would just say the alternative that people are doing is a lot more risky, right? They're getting a little short-term rental. They're the direct exposure to that as they're making decisions on it day to day, and there's just a lot more litigious world in that world. Whereas this, you're put on there for the first year to get the active losses, and then you get out of that exposure. But in reality, it's if something were to happen, you're the small fish amongst maybe 100 plus people, and more than likely the smallest pockets. A lot of these lawsuits, the way they work is like really what's the collectability of that individual. So I would, of course, talk to your own lawyer, but I would definitely say that doing the short-term rental loophole and that nonsense is way more exposure than this type of stuff. That's all subjective. I've heard of people also getting umbrella insurance. Don't know if that's going to kick in or not. I'm just being conservative, but that is an additional tactic that people will do. But some of these guys will say it's not really needed.
I don't know. I guess one takeaway might be for some people is, hey, if they're interested, if you or somewhere else they have a fund and they can do 50,000 or something and watch it happen for a little while and see how it goes.
You got to see it for yourself, right? I did this in 2018, 19. I flew into Dallas and I drove up a couple hours. I think I was in Oklahoma, but yeah, I went and kicked the dirt, looked at the wells. Don't know what really got for me. Or I met the geologist when I did that, but really it was just investing a little bit of money and then seeing that first year or two tax returns. And it's fun to see like the oil barrel reports, right? Because that gets transported and that turns right into dollars. But for me, it was like, how does the IDCs really work? And it just comes on a simple like K1 form. Just pass it over to your CPA. But I'm one of those guys that needs to see it for myself. If not, we'll see you guys on the next webinar. I usually do these the third Wednesday of every month around noontime Pacific. I'm going to be unveiling the new Circle group. So if you want to be part of that soft launch, shoot me an email, lane@thewealthelevator.com. Ideally, need you guys to complete that onboarding call with myself so we know who you are. And then also a reminder that the annual retreat is going to be in January 16th to 18th in Honolulu, Hawaii. I hope you guys all can come, and we'll see you guys next time. Bye.